Gold just crossed a threshold that historically signals the beginning of massive wealth transfers. And if you're holding physical gold right now, you're positioned on the right side of what's coming. Let me show you exactly what's happening in the markets that most people aren't seeing. The gold market is experiencing something we haven't witnessed since the early 2000s. Back then, gold was trading around $300 an ounce. Investors who recognized the pattern that was forming made returns that changed their financial lives forever. That same pattern is forming again right now, but this time the stakes are exponentially higher. Here's what I mean. Gold recently pushed through the 2,600 level and held it. Now, to most people watching financial news, that's just another price point. But to anyone who understands market structure, that level represents something far more significant. It's what technical analysts call a consolidation breakout, and it's the same pattern that preceded every major gold bull run in modern history. Think about what happened in 1979. Gold had been consolidating around $200 for months. Investors were getting impatient. The financial media was calling gold a barbarous relic that had no place in modern portfolios. Then something shifted. Gold broke through its consolidation range, and within 18 months, it had surged to $850. That's a 325% gain. People who held through the consolidation period saw life-changing returns. The same thing happened in 2005. Gold had been range-bound between $400 and $450 for what felt like forever. Skeptics said the gold bull market was over before it really started. Then gold broke out, and by 2011 it had reached $1,900, another massive wealth transfer to those who understood what they were holding. Now here's where it gets interesting. The consolidation period we just went through was longer and more frustrating than either of those historical examples. Gold hit its previous high around $2,075 back in August 2020. Then it spent years, literally years, chopping around, testing support, shaking out weak hands. The financial media wrote countless articles about how gold's bull run was finished, how cryptocurrency had replaced gold as the inflation hedge, how central banks were done accumulating. Every single one of those narratives was wrong. Because while the price was consolidating, something profound was happening beneath the surface. Central banks weren't just buying gold, they were buying it at a pace we've never seen before in recorded history. The World Gold Council reported that central banks purchased over 1,000 tons of gold in a single year. To put that in perspective, that's more than the annual production of every gold mine in China, which is the world's largest gold producer. Why would central banks be accumulating at record levels if gold's bull market was over? They wouldn't. These are the most sophisticated financial institutions on the planet, with access to data and analysis that retail investors can only dream about. And they're loading up on physical gold, like their currencies depend on it. Because they do. Let me tell you what's really driving this. It's not just inflation, though that's certainly part of the story. It's not just geopolitical tension, though that matters too. What's happening is a fundamental restructuring of the global monetary system, and gold is being positioned as the ultimate settlement asset in this new framework. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with their expanding membership, are actively working to create alternatives to the dollar-dominated financial system. They're not doing this because they hate America. They're doing it because they've watched the United States weaponize the dollar through sanctions, and they've realized that holding dollars makes them vulnerable to political decisions made in Washington. So what are they doing instead? They're accumulating gold, massive amounts of gold. China's central bank has been reporting gold purchases month after month. Russia has been converting its dollar reserves into gold for years. India, despite being one of the world's largest gold consumers at the retail level, is also building its official reserves. These aren't small players. These are nations representing nearly half of the world's population and a growing share of global GDP. And they're all moving in the same direction, away from dollars toward gold. Now you might be thinking, okay, but how does that affect the price I see quoted on my screen? Great question. Because this is where the mechanics of the gold market get really interesting and where the opportunity for gold holders becomes clear. The gold price you see quoted, the spot price, is largely determined by trading on the COMEX Futures Exchange in New York. This is where banks, hedge funds, and other large institutions trade contracts representing gold. But here's the thing. Most of these contracts are never settled in physical metal. They're paper contracts settled in cash. Estimates suggest that for every ounce of physical gold that actually exists in COMEX warehouses, there are somewhere between 100 and 500 ounces worth of paper claims trading. This system works fine as long as everyone's content to trade paper and nobody asks for physical delivery. But what happens when the world's central banks start demanding physical metal? What happens when countries that have been accumulating paper claims decide they want the actual gold? You get what's called a squeeze. The paper price and the physical price start to diverge. We're already seeing early signs of this. Premiums for physical gold coins and bars have been elevated for months. Delivery times from major mints have stretched out. These are symptoms of a market where physical demand is outstripping the available supply. And here's the critical point. If you're holding physical gold right now, you're holding the asset that's actually scarce. Not the paper promises, not the ETF shares that may or may not be fully backed. The actual metal. Let me paint you a picture of what this could look like as it unfolds. Imagine you're a pension fund manager in Europe. You've got billions in assets to protect, and you're watching the euro weaken against a basket of currencies. You're seeing inflation eat away at the purchasing power of your bond holdings. You decide you need gold exposure, so you call up your broker and place an order for physical gold. But there's a problem. The dealer tells you there's a 6-week wait for delivery, and the price you'll pay isn't the spot price you see quoted, it's spot plus a 5% premium. You don't have much choice, so you agree. You've just paid $2,730 per ounce for gold that's officially trading at $2,600. Now multiply that scenario by thousands of institutions around the world, all coming to the same conclusion at roughly the same time. The premium doesn't stay at 5%, it goes to 10%, then 15%. Then the premium becomes so large that it's not really a premium anymore. It's just the price of physical gold, and the paper price becomes increasingly irrelevant. This isn't speculation. This is exactly what happened in the silver market in 2020 and 2021. The paper price of silver was around $25 per ounce, but try buying physical silver at that price. You couldn't. Dealers were charging $35, $40, even $45 for silver eagles. The paper market and the physical market had completely disconnected. Gold is a much bigger market, so the disconnect won't happen as quickly or as dramatically. But the same forces are at work. Physical demand is rising, available supply is constrained, and the paper market is increasingly being recognized for what it is, a price suppression mechanism that can't hold forever. Now, I want to take a brief aside here because this is relevant for a lot of people watching. If you're sitting on $100,000 or more in traditional retirement accounts, 401ks, IRAs, that kind of thing, you might want to look into how gold IRAs work. I put together a free guide that covers the mechanics of getting physical gold into your retirement account without triggering tax penalties. It's in the description below. Worth checking out if you're thinking about protecting your retirement savings with hard assets. No pressure, just information if it's relevant to your situation. All right, back to where this market is headed and why gold holders are entering what I'm calling the winning zone. The winning zone is that period in a bull market where the fundamentals have clearly shifted, the technical breakout has occurred, but the majority of investors haven't recognized what's happening yet. It's the sweet spot where you're positioned ahead of the crowd, but the big move is still in front of you. We saw this in tech stocks in the late 1990s. There was a period in 1998 and early 1999 where the internet's potential was becoming clear to informed investors, but the general public hadn't piled in yet. That was the winning zone. If you bought quality tech stocks then, you made extraordinary returns before the bubble topped out. We saw it in real estate in the early 2000s. There was a window where property prices were rising, credit was easy, but the mania phase hadn't kicked in yet. Investors who bought rental properties in 2003 and 2004 built substantial wealth, and we're seeing it in gold right now. The fundamentals are screaming bullish. Central bank buying at record levels, currency debasement accelerating globally, geopolitical fragmentation creating demand for neutral reserve assets, technical breakout confirmed. But the average investor? They're still not paying attention. I can prove this to you with one simple metric: gold ETF holdings. These are the funds that allow investors to get gold exposure without holding physical metal. During gold's run to $1,900 in 2011, ETF holdings were surging. Billions of dollars were flowing into gold funds every month. Retail investors were buying. That was the mania phase. Right now, ETF holdings have been flat to declining even as the price has been making new highs. That tells you this move is being driven by central banks and sophisticated institutions, not by retail investors. The crowd hasn't arrived yet. And when they do, When your neighbor starts asking you about gold, when financial advisors start recommending 10% gold allocations, when gold becomes a regular topic on mainstream financial news, that's when we'll be entering the later stages of this bull market. But we're not there yet. We're in the winning zone, the zone where informed holders accumulate and position themselves for what's coming. Let me give you some specific price targets based on historical patterns and current fundamentals, because I think it's important to understand the magnitude of what we're potentially looking at. Gold's previous all-time high was around $2,075, reached in August 2020. We've now broken through that level and established it as support. In technical analysis, when a previous resistance level becomes support, it often leads to a measured move higher. The measured move from the 2020 consolidation range suggests a target around $3,200 to $3,400. But that's just the technical picture. When you factor in the fundamental drivers, the monetary expansion, the debt levels, the geopolitical shifts, the potential targets get much more interesting. Here's a thought exercise. In 1980, gold peaked at $850 per ounce. At that time, the total U.S. money supply, what economists call M2, was about $1.6 trillion. So gold was trading at roughly 0.05% of the money supply. Today, M2 is over $21 trillion. If gold were to reach the same ratio relative to the money supply that it hit in 1980, we'd be looking at a gold price north of $10,000 per ounce. Now, I'm not saying gold is definitely going to $10,000. Markets don't move in straight lines, and there are countless variables that could affect the trajectory. But I am saying that the mathematical relationship between gold and the money supply suggests there's substantial upside from current levels. And here's what makes this particularly interesting for gold holders right now. The risk-reward ratio is extremely favorable. Gold has broken out of its consolidation range, established support at higher levels, and is showing strength even as other assets are volatile. The downside risk appears limited. The upside potential is substantial. That's the definition of an asymmetric opportunity. Let me tell you about something that happened in 2008 that I think is really relevant to today's situation. When Lehman Brothers collapsed and the financial crisis went into full panic mode, gold initially sold off. It dropped from around $1,000 to $700 in a matter of weeks. People who didn't understand gold's role in a portfolio panicked and sold. They thought gold was supposed to protect them, and instead it was falling along with everything else. But here's what they missed. Gold was falling because hedge funds and institutions were being forced to sell their most liquid assets to meet margin calls. It wasn't that gold had lost its value. It was that it was one of the few things they could actually sell in a frozen market. And what happened next? Gold bottomed in October 2008 and then went on an absolute tear, rising from $700 to over $1,900 by 2011. The people who understood what was happening and held through the volatility, or better yet, bought more during the panic, made extraordinary returns. I bring this up because we might see similar volatility in the months ahead. If we get a major market dislocation, gold could pull back temporarily as institutions raise cash. But that wouldn't change the fundamental thesis. It would just create a better entry point for those who understand what they're holding. The key is to understand why you own gold in the first place. Gold isn't a speculation. It's not a trade you're trying to flip for quick profits. Gold is insurance against monetary instability, and it's a long-term store of value in a world where currencies are being systematically debased. Think about what's happened to the dollar's purchasing power over the last 50 years. In 1971, when Nixon closed the gold window and ended the dollar's convertibility to gold, you could buy a gallon of gas for about 36 cents. Today, that same gallon costs over $3. The dollar has lost more than 90% of its purchasing power. But here's the interesting thing. If you had held gold instead of dollars over that same period, your purchasing power would have increased. An ounce of gold in 1971 was worth $35. Today, it's worth over $2,600. That's not because gold became more valuable. It's because the dollar became less valuable, and gold maintained its purchasing power. This is what gold does. It's not an investment that generates cash flow or earnings. It's a monetary asset that preserves wealth across time and across currency regimes. And in an era where governments around the world are running unprecedented deficits and central banks are creating money at unprecedented rates, that preservation function is more important than ever. Let me share some numbers that really drive this home. The U.S. national debt is now over $36 trillion. That's trillion with a T. The interest payments on that debt are approaching $1 trillion per year. Think about that. We're paying nearly $1 trillion annually just in interest, not even touching the principal. There are only two ways this ends. Either the government dramatically cuts spending and raises taxes to pay down the debt, which is political suicide and probably won't happen, or they inflate the debt away by creating more money and devaluing the currency. History shows us which option governments choose. They always choose inflation. And when they choose inflation, what happens to gold? It rises. Not because gold is becoming more valuable, but because the currency it's priced in is becoming less valuable. This is the fundamental dynamic that drives gold prices over the long term. Now, we're also seeing something unprecedented in terms of geopolitical fragmentation. The post-World War II order, where the US dollar was the undisputed global reserve currency and American military power guaranteed the security of global trade routes, is breaking down. Not overnight, but gradually and unmistakably. China is conducting trade with dozens of countries in yuan instead of dollars. Russia has been cut off from the SWIFT payment system and has developed alternatives. Saudi Arabia, which has priced oil exclusively in dollars for 50 years, is now accepting yuan for oil sales to China. These are tectonic shifts in the global monetary system, and in this fragmenting world, what asset serves as the neutral reserve? What asset do countries trust when they don't trust each other's currencies? Gold. It's nobody's liability. It can't be printed. It can't be sanctioned. It's been recognized as money for 5,000 years across every civilization. This is why central banks are accumulating. They're preparing for a world where the dollar is no longer the sole reserve currency, where multiple currency blocks compete, and where gold serves as the ultimate settlement asset between these blocks. For individual gold holders, this creates an extraordinary opportunity. You're essentially front-running the central banks. You're positioning yourself in the same asset that the world's most sophisticated financial institutions are accumulating. And you're doing it at prices that, in hindsight, will likely look like bargains. I want to talk about the supply side of the equation too, because this is another factor that's often overlooked. Gold mining is an incredibly difficult and expensive business. It takes 10 to 15 years to bring a new mine from discovery to production. The ore grades at existing mines are declining, meaning miners have to process more rock to get the same amount of gold, and the easy-to-access deposits have already been mined. What this means is that gold supply is relatively inelastic. Even if the price doubles, you can't just turn on a switch and produce more gold. The supply is what it is, roughly 3,000 to 3,500 tons per year from mining plus recycling. That's it. Meanwhile, demand is accelerating. Central banks are buying at record levels. Asian consumers, particularly in China and India, have a cultural affinity for gold that Western investors often don't appreciate. When their economies grow and their middle classes expand, they buy gold. It's what they've done for generations. And now, you're starting to see Western institutional investors wake up to gold again. Pension funds, endowments, family offices, they're all looking at their portfolios and realizing they're overexposed to financial assets that depend on the stability of the current monetary system. They're looking for alternatives, and gold is the obvious choice. So you've got constrained supply meeting accelerating demand. Economics 101 tells you what happens next. Price goes up. The only question is how much and how fast. Based on the historical patterns I've studied, gold bull markets tend to last 8 to 12 years and see price increases of 300% to 600% from the beginning of the bull market to the peak. If we mark the beginning of this current bull market at the 2015 low around $1,050, we're about 10 years in. That suggests we might be in the middle to later middle stages of this bull run. A 300% gain from $1,050 would put gold at $4,200. A 600% gain would put it at $7,350. Now, we're already at $2,600, so we've captured some of that move. But there's still substantial upside if this bull market follows historical patterns. And here's the thing about gold bull markets. They tend to accelerate in the final stages. The move from $1,050 to $2,600 took about 10 years. The move from $2,600 to $4,000 or $5,000 could take just 2 to 3 years. That's the nature of bull markets. They start slow, grind higher, and then explode in the final phase when everyone finally recognizes what's happening. We're not in the explosion phase yet. We're in the grinding higher phase, the phase where the fundamentals are clearly bullish, the technical picture is constructive, but the crowd hasn't arrived. This is the winning zone. This is where patient, informed holders position themselves for the acceleration that's coming. I want to address something that I hear from skeptics all the time. Gold doesn't pay dividends or interest, so why would I hold it? It's a fair question, and it deserves a thoughtful answer. First, in a world where real interest rates, that's the nominal interest rate minus inflation, are negative or barely positive, the opportunity cost of holding gold is minimal. You're not giving up much yield to own an asset that preserves purchasing power. Second, gold's lack of yield is actually a feature, not a bug. Assets that generate yield, stocks, bonds, real estate, come with counterparty risk. They depend on someone else fulfilling their obligations. A stock depends on the company remaining profitable. A bond depends on the issuer making payments. Real estate depends on tenants paying rent and the property maintaining its value. Gold has no counterparty risk. It's just gold. It doesn't depend on anyone's promise or anyone's ability to pay. In a world where trust in institutions is declining and systemic risks are rising, that lack of counterparty risk is incredibly valuable. Third, and this is the key point, gold's yield comes from currency debasement. As governments create more money and devalue their currencies, gold's price in those currencies rises. That's your return. It's not a dividend check, but it's real wealth preservation, and often real wealth creation. Look at gold's performance over the last 25 years. From 2000 to today, gold has risen from around $280 to over $2,600. That's more than 800% return. Compare that to the S&P 500 over the same period, about 400%, including dividends. Gold has actually outperformed stocks over this time frame, and it's done so with less volatility and less correlation to other assets. Now, I'm not saying you should have 100% of your wealth in gold. Diversification matters, but the idea that gold is a dead asset because it doesn't pay yield is simply wrong. The data doesn't support it. Let me tell you about a conversation I had with a wealth manager who specializes in working with high net worth families. He told me that his typical client allocation to gold and precious metals used to be 2% to 3% of their portfolio, just a small insurance position. But over the last few years, he's been increasing that to 10% to 15% for most clients, and some are going even higher. Why? Because these families have wealth they need to preserve across generations. They've seen what happened in the 1970s when inflation destroyed bond portfolios. They've seen what happened in 2008 when the financial system nearly collapsed. They've seen what's happening now with unprecedented money creation and debt accumulation, and they're positioning defensively. These aren't gold bugs or conspiracy theorists. These are sophisticated families with access to the best financial advice money can buy, and they're allocating serious money to gold because they understand what's coming. The winning zone isn't just about price appreciation, though that's certainly part of it. It's about being positioned correctly for the monetary environment we're entering. It's about having your wealth in assets that will maintain their value when paper currencies are losing theirs. It's about being on the right side of the greatest wealth transfer in modern history. Because make no mistake, that's what's happening. Wealth is being transferred from those who hold depreciating paper assets to those who hold hard assets with intrinsic value. From those who trust the system to those who prepare for the system's failures. From those who react to events to those who anticipate them. Gold holders who understand what they're holding and why they're holding it are positioned in the winning zone. The fundamentals are aligned. The technical breakout has occurred. The institutional accumulation is accelerating, and the crowd hasn't arrived yet. This is the opportunity. Not to get rich quick, but to preserve and grow wealth over the next several years as this bull market unfolds. To be positioned in the asset that central banks are accumulating. To own the money that's been recognized as money for millennia. The winning zone doesn't last forever. Eventually, the crowd arrives. The mania phase begins. Prices get disconnected from fundamentals. That's when you need to be thinking about taking profits and rebalancing. But we're not there yet. We're in the sweet spot. The zone where informed holders accumulate and position themselves for what's ahead. If you're holding physical gold right now, you're in the right place. The question isn't whether to hold. It's whether to add to your position while we're still in this zone. Because once the acceleration phase begins, once the crowd recognizes what's happening, the opportunity to buy at these levels will be gone. The winning zone is here. The fundamentals are clear. The technical picture is bullish. The institutional accumulation is accelerating. And you're positioned ahead of the curve. That's exactly where you want to be in the early to middle stages of a major bull market. Stay informed. Stay patient. And understand that what you're holding isn't just a metal. It's a monetary asset that's been preserving wealth for thousands of years and will continue to do so long after today's paper currencies are forgotten.